Hello, everyone. Welcome to the Realist Idealists podcast channel. My name is Braden, and on today's episode, we are discussing everyone's favorite topic taxes. But in all seriousness, it never hurts to know more about taxes. For as the saying goes, nothing is certain except death and taxes. With that being said, we are the Realist Idealists, and this is Powerview. Now, Jordan won't be joining us as he usually does for this episode. However, he will be participating in our follow up episode on taxes, where we will debate whether or not we should have taxes in the first place. So make sure you keep an eye out for that episode when it's released. But for starters, for this episode, I think the best place for us to start is creating an understanding of what taxes are and what we use them for. So, of course, this may be common sense for most people, but nevertheless, here it is. Taxes are essentially fees imposed by governments on goods, services, income, and certain types of assets. These fees are typically determined by a percentage of the total value that is being taxed. These taxes, of course, are paid to the government that is imposing the associated taxes. And so, in the case of GST in Canada, which is the sales tax, the money levied by this tax is sent to the federal government since they are the ones imposing it. Typically, taxes are used to fund public services, pay for government obligations, and provide certain goods for citizens. Excuse me. Arguably, one of the most important reasons why we have taxes beyond paying for social welfare in all of its forms is to create demand for currency. A little fun fact for you. In the United States, the Federal Reserve, which is their central bank, came into being at the same time as the IRS, the Internal Revenue Service, which, for those of you who aren't aware or aren't American, um, the federal they are the federal agency responsible for taxes in the United States. Of course, this is no coincidence, right? As taxes are a major reason for people to use the country's currency, which we know from our last episode gives currencies its value today, right? The demand for the use of that currency. So, now that you have a general idea of what taxes are and what they are used for, it's time to get into the real bulk of this episode, and that's looking at the different types of taxes that exist. Now, I'm sure someone somewhere is going to say, "Oh, you forgot this tax, and what about this one?" And to that, I say, "Sure." But really, the reality is these 7 taxes or types of taxes that I'm about to explain, um, I really do feel represent the vast majority of taxes that exist in our world today. That's not to say that there aren't other kind of subcategories of these taxes that you're going to hear about in this episode, or even completely separate taxes, but these represent the majority. So, first on our list is income taxes. Income tax is a type of tax that is levied on an individual's wages, salaries, and other types of incomes like cash bonuses. These taxes are filed yearly, where you have to submit to the government how much money you earned in the previous year. This tax is often referred to as personal income tax, since it is a tax on the income of an individual, not the income or revenue of a business. An interesting note about income taxes is that for a number of countries, income taxes were actually introduced, or in some cases reintroduced, I guess, as a wartime measure to help support the troops, and just simply stayed after that. For a lot of countries, taxes are calculated using what is known as a marginal tax rate. The the way this system of taxation works is that income is broken down into tax brackets. Each tax bracket is a range of earnings, like say $0 to $15,000. And has a corresponding tax rate associated with that tax bracket. So, for instance, if you made $20,000, let's say, in a year, um, the first $15,000, using our kind of previous random example of the first tax bracket being 0 to 15,000, you would be taxed a certain tax rate. Let's say it's 15%, right? And on the remaining $5,000 of that $20,000 salary, you would be taxed at a different tax rate. For most tax laws, this means the more you get paid, the higher percentage rate you'll pay on that portion of income. I really want to stress that the total income is not taxed at the same rate. Only the income that falls under a certain tax bracket gets taxed at that tax bracket rate. Any additional income will be taxed on the next highest tax bracket, and so on and so forth. At the time of recording, in Canada, the federal income tax brackets and rates are as followed: $0 to $48,535 is the first tax bracket, and it's taxed at 15%. From there, we have 48,535 to $97,069, and that's taxed at 20.5%. The next, we have 97,069 up to 150,473 at 26%. 150,000 and 150,473 to 214,368 at 29%, and everything over that amount is taxed at 33%. Now, depending on where you live, of course, your tax brackets are going to vary. No different than even in Canada, the tax brackets at the federal level are very different than what the tax brackets are at the provincial level. But that doesn't mean that you don't have to still pay both. Number 2 on our list is corporate taxes, right? As the name implies, corporate taxes refer to the taxes related to business income. These taxes are levied on the income of both private and public businesses. This means that only the profit or earnings of a company are taxed, unlike the taxes we pay as consumers purchasing the products or services. Unlike the marginal tax rates we often see with the income tax, corporate taxes corporate tax rates are fixed or flat rate, meaning that the total amount of profit is taxed at the same rate. Depending on where you live, your corporate taxes may be a fixed rate regardless of the size of business, like in the case of the United States, or specifically the United States federal income tax. Or you could have a corporate tax rate for businesses classified as a small business, as well as a separate tax rate for any business who makes more than what is classified as a small business, like in the case of the provinces and territories in Canada. This means that if you are a big box store, right, that has lots of locations, lots of income driving, lots of revenue, you'll be taxed at a higher rate than someone who owns a mom and pop shop. Number 3 on our list is consumer taxes. Excuse me. Had to clear my throat there. Consumer taxes, as you would expect, are placed on goods and services purchased by individuals and businesses. The tax is levied on the person purchasing the goods rather than the person providing it. As mentioned previously, in the case of consumer taxes, the taxes are calculated on the total price of the good or service. So if an item costs $10, the tax would be a percentage of that full $10. Some consumer goods and services are exempt from taxes depending on where you live, such as groceries, right? So in Ontario, if you go to the grocery store and want to buy some bananas or flour, something like that, you don't have to pay taxes on those groceries. Number 4 is property taxes. Property taxes are the taxes you pay relating to assets owned by an individual or business. This tax is calculated based on an assessed value of the property rather than what its present value may be in a given market. The most common form of property taxes is real estate. In the case of real estate, the appraised value of the property would include the building as well as the land that the building sits on. But as mentioned before, unlike the swings in real estate prices you may see in a given year, the property taxes are assessed at the beginning of the year and stay for that given year, right? So you can have a situation where the housing market is super inflated and there's tons of demand to buy new houses. So houses are very expensive, and your property taxes may not reflect that high of a value of an appraised property, right? Sorry, the property is not going to be appraised at that high of a value. But you can also have a situation where, let's say, the market crashes, right? And housing prices drop dramatically. Well, you'll still have a similar situation where the property taxes are still going to look at the overall asset and just assess it based off of what is the value of that rather than what the market is dictating at the time. Some jurisdictions also tax things like cars, boats, and planes as tangible personal property. Property taxes are a bit of an interesting one because they are one of the few taxes that go to the municipality level of government, meaning you pay it to your local government rather than a national or state or provincial level of government. So it's seen as a really great revenue source for your kind of local community, I guess, is the best way to look at it. It's also one of the few taxes that you pay in perpetuity, which I will probably mention again later. But um, really, what that means is that unlike a consumer tax or even an income tax or anything like that, it's not a one time tax that you are paying to the government. You are going to pay it for the lifetime of owning that asset. And that leaves us to number 5 on our list, tariffs. Tariffs are very different, are a very different tax in comparison to the others we have mentioned so far. In that these taxes are imposed by a government on the important importing of certain goods. So it's not necessarily related to a domestic tax, right? It is a foreign tax. This tax can be done to target individual countries or an entire product or industry. We often see tariffs used as political, or used for, I should say, political reasons, but it can also be used to protect certain local industries. Anyone who chooses to import those goods that have a tariff associated with them will have to pay a fee or tax to the federal government. So let's say we have a tariff on uh, cheese, right? And because we want to protect the local cheese industry of Quebec or somewhere. um, if you wanted to buy some cheese from the United States or France, if there was a tariff that was associated with cheese products in general, you as a business owner or a consumer potentially, if you were just buying it for yourself, would have to pay a tariff, essentially a fee on top of the price of those goods that you're bringing in. Up next at number 6, we have capital gains tax. Capital gains, for all my non-investors out there, are taxes you pay in selling of an asset that is not held within a tax sheltered account or trust. These can be anything from stocks to property. Similar to corporate taxes, capital gains tax is a percentage of the total profit made on the sale of an asset. The profit, of course, is calculated by taking the difference between the original purchase price or fair market value, sometimes in the case of properties, and the price of the asset at the time of sale. In Canada, only 50% of the capital gains is taxed, meaning this 50% is added on to your personal income tax, or corporate tax, I guess, of the individual or business, and essentially is treated as additional income. But the nice thing about it is that you're not actually dealing with the entire 100% of profit, right, that you have made as in the form of capital gains. Only 50% of that asset is going to be taxed, but it is going to be taxed at your personal or corporate income tax marginal tax rate. This is different from how it works in the United States, since in the US, capital gains are taxed at a different rate than income tax. In the US, the entire capital gains or profit from the sale of the asset is taxed. And the tax rate at the federal level is either 0%, 15%, or 20%, all depending on your personal income of the of all depending on the personal income of the individual who sold that asset. So if you make more money in general, then your capital gains are taxed at a higher rate. If you make less money, of course, you're maybe will be lucky enough to only pay 0% in tax. And finally, number 7 on our list, we have estate tax or an inheritance tax. This is a tax levied on what is known as generational wealth, or simply put, the inherited wealth left behind by the deceased. This means that when you inherit wealth, whether it be in the form of cash or assets, depending on where you live, you as a beneficiary of that wealth may have to pay taxes on it. In Canada, we technically don't have an estate tax on inherited wealth, meaning if your grandfather or someone leaves you $1 million in cash when they pass away, you don't have to pay any tax on it. However, there is a bit of an asterisk when it comes to assets and that are being inherited, like properties or stocks. For these types of assets, aka everything except cash, capital gains taxes are triggered essentially at the time of death of the deceased. There's a bit of even a caveat with that, of course, that depending on, let's say, if it's stocks, really, if those are held in a tax sheltered account that isn't at the maturity date that they had to be removed from that type of account, um, there are ways around that where maybe if you have room in your tax sheltered account that they can be moved into there. But that's getting into a little bit more finance things. So for the purposes of our conversation today, really just focus on that. These are these are assets that can be taxed in the when they are inherited. Um, so the reason why it is a capital gains tax, the reason why it's a capital gains tax rather than an inheritance tax is because the tax is not applied to you as the beneficiary, but rather it's applied to the deceased's final income tax statement, right? So even though it may kind of feel like you're still paying it, because the deceased is no longer there to kind of fill out their last income tax, really because the money or the asset itself is being taxed under not your personal tax bracket, but the tax bracket of the deceased, in which case potentially could be a lot lower than yours if it is like a grandparent or something, or a parent. Um, because it's taxed at their capital gains tax rate. Um, that's why it's not considered an inheritance tax. So even though these taxes still kind of at the end of the day are you paying for it, um, it's really because it's coming out of their finances rather than yours. It's not considered an estate tax. In countries like the United States, however, there are estate taxes, which essentially a similar system to that of capital gains taxes, but you as the individual inheriting those taxes are going to pay um, taxes on it based off of your personal income. So now that you have an idea of what taxes are, what we use them for, and the different types of taxes, or rather the different sources of income that are taxed, I'd like to slightly shift gears and focus on what this podcast series is really all about, and that's looking at what's wrong with the system, or at least what I feel are kind of some of the major flaws with all these different types of taxes, or maybe loopholes, I guess you could say. So for starters, let's look again at income taxes. Let's say you have a person who makes $48,535, which just happens to be the max amount of money you can earn to fall under the first marginal tax bracket at the federal level in Canada. And let's also say you have another person who makes 500,000. If we take Canada's federal income tax rate for both people, their first $48,535 will be taxed at a rate of 15%. If I do my math correctly, or if I've done, I should say, my math correctly, this works out to around $7,280 in taxes. Now, so it should be stated, for simplicity's sake, we are going to pretend that there are no provincial taxes and there is no additional deductions and ways to kind of save some money. We're just going to take that flat 15% and take it from their salaries, right? Um, so the person who made $48,535 as their total salary is paying $7,280 in taxes to the federal government, which works out to being a take home of $41,255. This is the exact same for the person who makes $500,000 when it comes to their first $48,535. So, on that same amount of money, they will take home the same amount, as in $41,255. When you calculate the total tax rate, or what is often referred to as the effective tax rate, um, this is where you essentially look at the total taxes a person pays, and then figure out what percentage of their salary or their income, I should say, um, is the amount paid in taxes, right? So, for example, obviously, the person who made $48,535 in our scenario, their effective tax rate is 15% because that's nice and easy. They're only in that one marginal tax bracket, and that's their entire tax rate. Um, the second person, on the other hand, who made $500,000, is taxed at an effective rate of 29%. Again, hopefully I did my math correctly, but since the person who makes $500,000 fills every tax bracket, since the highest tax bracket is uh, everything above $214,368, right? And that's taxed at 33%. This works out to the person making $500,000 taking home $356,000, uh, $96.44. Sorry about that. It took me a moment to think about that. of their $500,000 salary, right? So uh, they're definitely taking over half of their salary, right? Because we've established that they are taxed at an effective tax rate of 29%. Now, at face value, it may seem like that the 15% marginal tax rate, or in this case, even the effective tax rate, is still better than having income taxed at a marginal tax rate of 33%. In the case of the person who made $500,000. Um, or even going further, the effective tax rate of 29% when you take into account the total amount of taxes paid on that $500,000 salary. It still seems like a harsher or a bigger pill to swallow, right? That you're going to pay either 33% on kind of all your income above $214,000, or even just in total paying 29% in comparison to 15%. And objectively, you could say that, yeah, that to a degree, that is the case, right? Um, Especially when you compare it to someone who makes a lot less money, paying a lot less taxes. 15% is always going to be a smaller number than 33% or even 29%, right? Depending on what you're looking at. But if you really think about it, that's only one way of looking at it. Really, it's all a matter of perspective. It is important to remember when looking at how these individuals are taxed that no matter the income disparity between the two individuals, they are both taxed equally, right? And I really want to stress that equally aspect. Um, but before I get too ahead of myself, I can already hear you saying, well, yeah, isn't that a good thing, right? Of course, being equal is seen as a positive thing in our society. But for me, I'm not really sure that in this case that's a good thing, right? If we really look at it from the individual's kind of experience, right? If we take the person who made $48,000, paying a little over $7,000 in taxes, um, $7,000 is a lot of money for someone who made only $48,000, right? When you have to live off of the equivalent of $41,000, um, that every dollar is really going to count, right? Um, in contrast, you look at the person who made um, $500,000 at $7,000 on that first $48,000 really means nothing, right? That's not going to affect their overall lifestyle, as opposed to that person who made only $48,000, took home $41,000. Uh, that $7,000 is going to be the difference of where you get to live, what you get to eat, if you get to eat, maybe depending on how crazy your life situation is, right? Maybe you have a family you have to take care of. Maybe you live in a city like Toronto, and your rent is extremely high, right? Who knows? Whatever your scenario may be, but I think objectively, at least in most parts of Canada, I'd like to think, maybe not all parts, but $41,000 is not a lot of money. You can't do a lot with something like that, right? So that $7,000 that they had to pay to the government really is going to make a huge difference. But that $7,000 for a person making $500,000, again, we're just talking about that first $48,000 that person had to pay taxes on. That $7,000 is not going to make a huge difference, right? Even if we want to go a step further and look at the total tax the person who made $500,000 is paying, which is kind of roughly around $145,000 in taxes, that still leaves them with a take home of around $355,000, right? So again, I I realize that there are people in this world that make crazy, crazy kinds of money, and there are things in this world that cost like an immense amount of money. So, sure, relative to the lifestyle of multimillionaire, billionaire, that kind of world, yeah, maybe uh, losing out on that $145,000 may feels like, oh, you could have had a way different lifestyle. But all things considered, if you're still making $355,000 um, after taxes as your take home, your lifestyle isn't changing that dramatically for the negative, I guess, is really the other thing to stress, right? Obviously, you can do a lot with $145,000, but to say that you have to make some real hard decisions because you don't have that kind of money, um, I think that would be a hard argument to justify, especially if you're speaking to someone who makes $48,000 a year, right? Um, because yeah, that 29% effective rate on $500,000, it's a lot of money. Um, in fact, right? Like if you looked at it just as like $145,000, well, like that's almost the equivalent of 3 years' salary for that person who made $48,000. So it's not a small chunk of change, but relative to the lifestyle of that person, I'd like to say that all things considered, um, they are not as negatively impacted as the impact of someone making $48,000 having to pay $7,000 of that towards taxes, right? Now, don't get me wrong. Uh, I'm not someone who thinks making a lot of money is a bad thing, right? I, I, it, the complete opposite, right? when it comes to that, and I'm a firm believer that um, you should want to work hard and benefit yourself to the absolute extreme, uh, and use your talents to earn as much value towards yourself and your community as possible, right? And I know a lot of people would be saying that, well, if you only make $48,000, well, just get a better job, right? Why should I have to whatever subsidize your life, right? Um, Not to mention, if you make a lot of money, like again, I'm nowhere close to $500,000 salary by a long stretch, but I recognize I don't make I make decent money, right? So, and I know even at my level of taxes that it hurts when you see how much money you pay in taxes. So I know for someone, if they were making a $500,000 in income, paying 29% of that towards taxes definitely feels like a quote unquote WTF moment, right? You're like, to see that end bill of how much money goes towards taxes, that hurts, right? Because that's money you worked hard to earn, right? Um, but I think if you really think about it, you'll realize that the way that our system actually translates and works out is that we end up punishing people who make less, because it's not it's really not just like looking at the actual individual numbers. It's about the impact on their lives, right? So if you make less, sure, you're only paying less in taxes, but there's an argument to be said that um, if you make only $48,000 as a whole, paying any dollar in tax is pretty rough in terms of you being able to make some decisions in your life, right? Or it it really takes some of that decision making out of your hands, right? You might not be able to live a certain place, right? We talked about that already, right? What you can eat, where you can go, what activities you're doing, right? You name it. But yeah, so it's funny because as a tax system, right? The part of the reason why we have taxes is, as we had mentioned, is to fund different things, government programming, social services, roads, whatever. Excuse me. Oh, double cough. um, but as a whole, taxes or like governments are seen as kind of as a bit of a social welfare system, right? Their job is to kind of, whether it's redistribute wealth or have programs to support those who can't support themselves as well as others, right? Um, at least in a democracy, that's typically the case. Um, but it is interesting that even in a system like that, and the kind of general idea around taxes, that you still have a system that, depending on how you look at it, disproportionately affects poorer people than wealthier people. Even though the reality is wealthier people pay way more in taxes if their money, we're talking about income taxes here, right? So um the money that they've earned on an income tax base, they pay way more in taxes. Um, but again, the impact on the lifestyle is minimal in comparison to the every dollar counting situation of someone who makes less than $50,000 a year or whatever that may be, right? So it's definitely something to kind of consider, right, when we're talking about this. Um, but yeah, so I mean, the it's easy to say that, okay, here's a situation where people are being negatively affected, but what's the alternative, right? Because a lot of us, I think, feel that we tax the wealthier we tax wealthier people already more than poorer people. So I don't know, we all kind of have to pay our share or equal share and help out society. So where do we kind of go from here? um I'm not going to say that I have the perfect answer, right? Um, but as you could probably, I guess, guess from what I'm saying, my idea, or quote unquote an ideal situation, would be more of an equitable based tax system rather than equality based tax system, right? Uh, as mentioned before, equality is great, right? It has its purposes, but in some cases, having an equality based system doesn't do justice to the kind of parties that are involved, right? Um, an equity based system would recognize that someone who makes a lot less, even if they are paying less in taxes, we we should be looking at it from the standpoint of, okay, where's the threshold for being, hey, even if I have to pay taxes, it's not going to be a massive detriment on my life, right? And that's what the kind of scale should be looking at, rather than just simply like, okay, you get to pay some, I'm going to pay a little bit more because I make more than you, and the person next to me who makes even more than both of us combined, they're going to pay even more, right? Because that doesn't look at what the end result is going to be. Um, if you paid that $7,000 in taxes and now you can't afford to live where you were once living, or you have to buy certain types of food in comparison to other types of food, right? Whatever the situation may be, an equity based tax system would try to address that, right? So, what do I really mean by that? Um, as a whole, obviously, an equity based system, like I've already said, that would address the fact that some people need more assistance than others, right? Which is what our tax system tries to already do. It tries to recognize that, but I think an equity-based system would do it a little bit more. So here's a hypothetical example, right? For simplicity's sake, let's just continue with the marginal tax rates that you've seen with the Canada's federal income taxes, right? So you got that 15% on that $48,535, right? If you made only that $48,535 of total income, then your tax rate, let's just say for argument's sake, is 15%, right? However, let's say you made $97,000, right? So on your first $48,000, I would say that maybe you should be paying more than 15% on your taxes, right? And then you could go further with someone who made um, more than $97,000, like whatever, like how we had that person who made $500,000. They would be paying more than the person who made only $48,000, and they would also be paying more than the person who made $97,000 on their first kind of marginal tax rate, right? So like maybe they pay 20% on their first 48,000, as opposed to the person who paid 97%, or the person who made $97,000, maybe they pay, I don't know, 17%, right? I'm just throwing out numbers here. Really, you can pretty much ignore the 15, like the numbers that I'm talking about in terms of percentages altogether, right, for the moment. And really just focus on the fact that it's a system that incorporates the concept of taking into account the impact of taxes on individuals relative to their total income, right? Um, it allows obviously more support for those who need the support, and I I know that like the issue always comes back up of, if you make less money, go get a better job, go get like something that pays more, add a second job, whatever it may be that you might try to justify. Um, And like I said already, wherever possible, sure, you should be trying to better yourself, to get a better job, to learn new skills, to have a side gig, whatever, right? That's something that myself and my wife, we do often with our lives, where we try to supplement our income, because that's an important part. We want a certain yeah, a certain lifestyle, and so we work hard to make sure that that's a possibility, right? um, but there's a reality that, one, that's not always possible depending on who you are. It's a bit of a, you could say that there's a bit of a question mark on how accurate that would be, but I think that there are cases where that's not possible. Maybe you have kids and you just um maybe you're a single parent and you don't have the ability to have someone watch your kids or something like that, right? um but you also have situations where you have certain jobs that do require skills, right? Skills that maybe not everyone has, but it's not necessarily a job that pays well, right? Like a prime example in my mind for this is someone who's a support care worker, right? Whether it's working in retire, like a nursing home type of situation, or if you work well, if you work in the like school board and support individuals with exceptionalities, right? Whatever it may be, right? um but that kind of care worker, right, a PSW, um depending on the situation, that person may not make a lot of money, right? And it's not because they're not skilled, and it's not because they don't have things that others can't provide, right? Because I think the argument is that in a job like that, well, it's a body. So as long as I put a person there that's willing to support support, then anyone in theory could do it. But I would make the argument that it takes a real um real passionate, a real patient, a real caring, a real whatever, you name the adjective, type of person to go into that field of work and actually be successful at it, right? I don't know that a lot of people that I can think of in my life that would automatically be able to just fall into those roles, especially knowing that the pay is what it is, right? Um, and so that's someone who works really hard at that job, but they're not going to necessarily have that six figure plus salary at the end of the day, right? So I think in acknowledging that, we should be willing to accept that there's always going to be people in society that will need a little bit more support. And it's not just because they're freeloading on society, right? It's because they deserve the extra support. Um, I also like this idea, right, from the standpoint of a bit of a reverse psychology, right? Um, I think a common argument when it comes to taxes, income taxes, that is, um, there's always a conversation around raising the like marginal tax rate at the highest level, right? So, uh, whatever, maybe you're adding another tax bracket and saying everything at that from that point on is taxed at 70%, right? You sometimes hear that number thrown around. Um, I think when you look at a system that maybe taxes a little bit more heavy on the first, like the front end of your income, right? That first marginal tax bracket, that second marginal tax bracket, so on and so forth, obviously, depending on what your salary is. Um, it kind of feels a little bit less of a disincentivizing you to make more money, because I think like my wife and I were talking about this just recently when it comes to taxes, that it's hard that because when you make a certain amount of money, if you, well, one, it could just be that your money is in a higher tax bracket in the first place, and so every dollar that you earn at that tax bracket, so like for instance, just to utilize the easiest one, that $214,000, everything above that is taxed at what was it, 33%, I believe, um at the federal level. So that's every single dollar you are losing 33% of that. And again, that's not talking about all the other like provincial and territorial taxes or whatever else, right? So 33% goes away right off the bat. So even in a situation where um, you might be making a lot of money and then you make a little bit more and that pushes you to the next tax bracket of something, right? So there's all those different layers to it where it feels like the extra work that you put in, if you raise the tax brackets at that end of things, like those marginal tax brackets, those tax rates feel a lot more painful in some ways than say if you were talking about, okay, on my first $48,000 I paid a little bit more than the next person who made only $48,000, right? And again, it's reverse psychology, right? I'm not trying to say that it is necessarily a complete difference in pay, right? Like if I raise the tax rate at the other end of the spectrum, um, then sure, it I might be paying the exact same amount of taxes at the end of the day. Um, but like I said, it feels a lot different, both for the person who has to pay a little bit more in taxes, as well as I think for the person who makes only that $48,000, because then at least it feels like, okay, I paid $7,000, let's say, but at least I know that the person next to me had to pay a little bit more on their first $48,000, right? Um, I do want to say that I don't really think that fully addresses things. Like I think one, there's a lot that would have to be figured out with something like that. You'd have to figure out real numbers to make sure that that all works in terms of tax rates, right? Maybe your initial tax rate is not 15%, right? Maybe it's a lot less, so on and so forth, right? Um, the other thing is that um, there are other ways to kind of do the same thing that I'm really talking about, and that would be, for an example, if you um, came out with additional tax credits or deductions and stuff like that for lower income earners, right? Um, the benefit of something like that, and again, I know we didn't really talk about um, tax credits and those types of things in this episode, but that would be a way to shelter some of the salary of someone who makes a lot less money, so that instead of paying 15% on that full $48,000, maybe you're only paying 15% on $20,000, right? Something like that, right? Go figure. Again, I'm not talking, we don't need to talk about specific numbers, but it's the concept of looking at the system from that standpoint of how do we make things a little bit more fair, recognizing that from a cost benefit side of things, the person who makes a lot less, every single dollar is going to count way more than someone who makes two, three, four, five times as much as that same person, um, because they have a lot less money to work with. So then when you lose a dollar, that's a big deal, as opposed to if I have $10 for every $1 you have. Well, if I lose a couple of dollars here and there, that that doesn't change my overall lifestyle, right? Or like I said, it might change your lifestyle, right? The difference between having this luxury versus another luxury, but it's not going to change your lifestyle to the point that it's detrimental in any way, right? You will still be able to live your life on a positive note. Now, I know we've talked about this quite a bit, so I don't want to go beat you over the head when it comes to income taxes, because there's lots going on with this, right? It is an intricate system, but hopefully you're kind of getting the idea that it isn't always the most fair depending on who you are within society, right? In that my stance would be that if you could get more to an equitable place when it comes to taxes in particular, I think that that would be beneficial. And I'm going to leave it with just a bit of a, I guess, an analogy, right? Um, let's say you have two people and they are donating $1,000 to charity, right? Both of them, person A, person B, both give $1,000 to a local charity, right? At face value, I don't know about you, but obviously there's crazy donors out there. But $1,000 is a pretty big sum of money to give to charity, right? I think most people would agree with that. That's a pretty awesome charitable donation. But now, if we get a little bit more kind of into the details of it, let's just say person A makes $30,000 in a given year, right? That's their income, and person B makes $300,000. We'll just keep it simple like that, right? Both again have made that $1,000 donation to the charity, but I think it should be relatively obvious that for one of those people, aka the person who only makes $30,000, that is a larger, I was going to say commitment, but larger impact on their wallet and personal sacrifice, right? If you want to call it that, than in comparison to the person who made $300,000, right? So they both donated the same amount, but then the the person with $30,000, that $1,000 represents a lot more of their total salary, right? So it works out to being like 3.3% of their total wealth for like that salary, right? Um, if the person who um, if the person who had $300,000 to their name, right, wanted to match that donation properly, they would have to give $10,000 to still give that same 3.3%. Um, the dollar value, of course, when it comes to $10,000 is much higher. And it seems like a lot more money, but overall, the impact on their wallet at the end of the day is the exact same from a kind of percentage standpoint of, hey, what are you paying, right? I would go even a step further, right? Like, so obviously they're both paying 3.3% of their money towards charity, which is great. And that at least looks a little bit more even. I'm sure from a surface level, you would say, wow, the $10,000 is a lot. Like, good on that person. Um, but I think that there's also, like, if you go even a step further and say, $10,000 for someone who has $300,000 is not a lot of money, all things considered, in comparison to someone who had $30,000 who gave away $1,000. And again, I hope that that kind of parallels with the tax conversation. That at the end of the day, that it percentage wise, we're talking about the exact same thing. They're both giving a relatively same impactful donation, but because this is money that we're talking about, and that this money is what you use to survive in life. Um, every dollar, I know I've kind of said this a bunch of times, but every dollar is going to count with the less when you have less money in the first place, right? If you um only make $30,000, that's going to be a huge deal. The $10,000 that the person who made $300,000 donated is literally a third of their salary, right? Like, and that's the equivalent of only 3.3% for the person who had $300,000, right? So hopefully that makes sense. I know I've talked a lot, heads are probably spinning, but hopefully this makes a lot more sense, and the rest of them going forward should be a little bit more straightforward, I hope, at least. But income taxes obviously are a large topic. It's something that affects really all of us for the most part, and it's something that we talk about a lot just in our daily lives. So with that being said, let's move on to the implications with corporate taxes. A bit of background actually to hopefully help with this making a little bit more sense. There was a time in our history when corporations didn't exist. If you owned a business, that business was yours and therefore just a part of your personal income. Nowadays, without going into too many details, corporations are the legal entities of our businesses. This means that though you may own the business, you are not personally liable for your business. Bear in mind that in countries like Canada, you may own a small enough business where you are simply a sole proprietor, and therefore your income for your business, from your business, is just tacked on to your personal income. As corporations became a thing, corporate taxes also came along with it, as you were no longer simply taxing the owner's personal income. Overall, we have promoted a culture in most societies to increase deductibles and decrease taxes when it comes to businesses. This is done in hopes to continue to stimulate the economy, as of course, many businesses are the driving force in our economies. The logic being that the lower the taxes, the more likely companies will grow. And since businesses employ people, the more businesses grow, the more people they can potentially employ, which of course should be seen as an obvious good thing. Now, this is all well and good, especially for the middle class or kind of small businesses, since they can keep more of their money and continue to grow their business. But when it comes to wealthier, more established corporations, this just really allows them to keep a greater amount of their wealth. The major difference comes when looking at how small and large businesses utilize deductibles found in corporate law, tax law. Since large businesses have more wealth, they are able to write off more and deduct more from their taxes, since they simply have more. This includes losses being used as deductibles, as well as business purchases that are eligible to be written off as business expenses, which inevitably are deducted from the total profit. Though small businesses are eligible for basically all the same deductibles that large businesses utilize, they lack the size to ever take advantage of these deductibles, at least to the same degree. The more amount of expenses, the more deductible income. Deductibles tend to be broken down into two categories. And these two categories are also deducted at different rates, kind of similar to if you had medical benefits. Depending on what you utilize, a different deduction rate applies. In the case of taxes, this is everything from interest on loans to advertising to travel to legal fees and more, right? In comparison, a small business doesn't have nearly the same amount of potential tax deductions relative to that of a large corporation, right? However, a big business like, say, Amazon, is able to deduct almost every single dollar worth of profit, um, so that they don't pay any money in taxes. They're obviously, when we think about it, one of the largest corporations, um, in a general sense of like what we think of in the retail space and the e-commerce space. Um, but we often see that from a tax standpoint, they don't pay money in taxes because they're seen as not profitable. And that's really because their um, expenses outweigh the profit that they bring in. So they're able to just constantly snowball and grow from there. Um, it gives the appearance that a company that really is kind of technically profitable, um, as being something that is non-profitable just simply because they reinvest their profits, right? Which again, at its surface value or whatever you want to call it, right, at its surface level, um, it's a good thing that we have the ability for businesses to do that. But I think kind of similar to the income tax situation is that there does come a line where the benefits of our tax code, when they're supposed to be trying to help the bottom half try to like kind of grow and move up in the world, these benefits within our tax code just get really exploited at the end of the day, because it's great that Amazon has grown to what it is. And I don't even want to keep using Amazon as an example. Use any company for that matter that you know of that is a large corporation, right? Your uh whatever, your Walmarts or your, I don't know, Home Depot, any of your kind of big box stores, right? Um Costco, whatever. Um all of these stores, or these companies, I should say, right? Because it's not just retail. I know I named a bunch of retail there, but all of these companies, um, they've kind of moved past that point of their growth phase, but yet they're still benefiting from the tax code from a growth phase standpoint, right? These established companies are able to constantly reinvest and not pay taxes on any dollar that they're kind of generating from their revenue, um, to just essentially pay back all of their expenses on operation costs and then grow their business further, um, at a basically essentially for a lot of these companies at tax free. Now, again, I was generalizing in the sense of which companies there, but the overall aspect of large corporations being able to reinvest all of their money into their business, that really is a reality for most, if not all, of the companies that you can think of today. Hopefully that makes sense. Hopefully you get an idea. In terms of an alternative, right? I think hopefully it's somewhat clear, but my thought would be around this idea of creating a threshold for where when companies are no longer in their growth phase, changing the tax code to make it so that there are not maybe as many deductions, right? Because again, in a weird way, like corporate laws, the corporate tax code kind of incentivizes monopolies in a lot of ways, because it's just telling businesses to keep growing as much as they can, and of course the company that is at the top is going to be able to grow at the fastest rate because or so, not maybe at the fastest rate relative to, um, they're not maybe doubling year over year as opposed to someone who has one store could maybe double in a year's time. Um, but in a general sense of kind of their spread within their market space, um, because the tax code allows them to save a lot more money, it really does change that dynamic between a small and a large corporation, right? A small business competing with a large corporation. Um, the tax codes, even though they are equal, again, that sense of equality versus equitable, natures within our tax codes, um, they they really don't reflect what we kind of are aspiring to when it comes to creating, um, tax codes that are supposed to stimulate the economy, right? But again, like I said, hopefully that makes sense. I feel like this is a bit of a theme with this, uh, equality versus equitable, aspects when it comes to the tax code. But yeah, if we could have a bit of a line, a threshold where a company is grown to a point where it's, you know what, you you've benefited from the tax code to allow you to grow. Maybe it's time that you put a little bit more of that money back into the public system. Again, just a thought. Next up on our list, we're looking again, once again, I should say, at consumer taxes, right? And the implications with consumer taxes. Um, as a whole, you could arguably say that consumer taxes are one of the more balanced forms of taxes or tax codes that we have. For the most part, a consumer tax is just simply the tax you pay when you purchase something. Where this differs is that depending on where you live, some goods are maybe tax free, right? I think I had mentioned earlier, but um, if not, regardless, I'm going to mention it now. The most common example of something that doesn't have consumer taxes on it is groceries, right? So, living in Ontario, if I go to the grocery store and I want to, whatever, pick up bananas and flour and a loaf of bread and chicken fingers, from the frozen chicken fingers from the grocery store, I don't pay taxes on those groceries, right? Um, that's a real random grocery order, but nevertheless, if that's what I was getting, um, I wouldn't pay taxes on that because groceries are not taxable in this province. Um, and it's really because food is considered an essential everyday item for most governments, um, or at least for our government. Um, and so for that reason, we don't get taxed on it. However, the kind of flip side of that is that you do get taxed when it comes to a restaurant. So if I was buying food that was prepared, like a restaurant or something like that, that's where you would pay taxes, like a consumer tax. And that's simply because you're not really fully just paying for the food, you're also paying for the service of someone cooking and serving you the meal, rather than, right, like just the unprepared food, where you have to put all the effort into it. Right. So one's for a service, one's for an essential good. Right. Um, since this form of tax is really based around you paying for what you purchase and nothing more, the tax is one of the few equitable taxes that we have today. Right. Um, if I choose to buy a car, well, then I'm paying the taxes on that car. If I choose to buy, um, a pizza, then I pay the taxes on those pizzas, right? Um, so you really are paying for what you want, right? Again, it's a capitalist system, so of course, someone who makes a lot less money is not buying a yacht or something like that, right? Like, so they're not going to be dealing with those kinds of taxes, and at the end of the day, the taxes are the exact same based off of uh what you are paying for, right? Like, what, depending on what you're buying, right? So um even with that kind of be said, like, it should be noted that depending on where you live, you may not have consumer taxes at all, right? um for instance, I'm trying to think of where, uh I don't know. I can't think of. I wanted to say like Dubai, like UAE potentially doesn't have a consumer tax, but don't quote me on that. But yeah, so you'll have some systems where some governments where they don't have consumer tax at all, right? Um, so that kind of plays into, they probably are driving tax revenue from a different source. So there might be some caveats with those types of systems. But as a whole, a lot of places do have consumer taxes, and I guess you could argue that if I had a lot of money and I was buying the same thing as someone that has not a lot of money, that maybe it could be more equitable by charging different levels of taxes. But I personally feel, when it comes to consumer taxes in particular, that if again, if you're going to have a capitalist system, you got to own it, right? At the end of the day. So um I don't think that you should have uh, a fully equitable system in that sense, right? Like, I think the equality based system that we have with consumer taxes, where, like, in the province of Ontario, we have what's called the harmonized sales tax, um, which works out to be like 13%, right? And that covers both the provincial and the federal level of taxes. Everything kind of applies that has consumer taxes applies to this harmonized sales tax, whether I have more money or less money. If I'm choosing to buy it, again, I know that it's a bit of a hard one. It may seem a little contradictory in some ways to what I've already said when it comes to uh, corporate and income taxes, but I hope as a whole you can see that with a consumer tax, because it's you getting that product at the end of the day, paying the taxes towards it, I think, can be a lot more justified than in comparison to some of the other things that we've been looking at. Next up, once again, we are looking at property taxes. I kind of look at this as paying for the land you don't actually own, right? Property taxes is an interesting case. Well, I guess it's as interesting of a topic as you can get when it comes to taxes. Like I mentioned earlier, property taxes are levied on the property that you own in perpetuity, meaning that this is not just a one-time tax like a consumer tax where hey, I'm buying this house and I pay a tax on it, and that is a consumer tax. But when it comes to properties, you additionally will pay a tax yearly, just simply for owning that property, that asset, right? Typically, we think of property taxes when referring to houses, which I kind of already mentioned, and or other business properties, right? Depending on the municipality, you may also see things like vehicles also being considered a property tax, or you can also see vehicles having a property tax associated with them, like a boat would be an example of that. So let's take for an example, houses, right? Because it's the one that I think people know the most about when it comes to property taxes, and arguably it's the most common. When you go to pay your property tax, for most of us, we pay a percentage of what the physical asset is worth. In this case, the house, and as well as a percentage of the land value that the house sits on, right? Now, I don't know about you, but property taxes feels like one of the most annoying taxes. I owning a house, my wife and I, when we have to pay property taxes, especially because it's paid like 3 or 4 times a year, and it kind of comes up out of nowhere, and it's a good chunk of change that you have to pay out, and I think for the most part you pay that money, and you're not quite sure what that money is even really going to, right? It just feels like a uh, almost a punishment for owning property, right? um Especially because it's like, well, nothing really changed. And the other weird thing about property taxes, um is that if you increase the land value or increase the value of your asset. So, um, a bit of like a little short story or whatever. um, we finished our basement, right? And so, in finishing our basement, that raised our property taxes. So, putting the money into making our house better, more livable, whatever you want to call it, right? Um, we then had to pay even more in property taxes going forward. Like we still pay that extra. It wasn't like a one-time thing or anything like that. Um, if whole neighborhoods maybe like update and like whatever, make the land look nicer. I don't know, make nice gardens and manicured lawns, and then it looks like a very um prestigious area, for instance. Well, that raises property values because the land itself, the value of wanting to live in a place like that increases, and therefore your property taxes are probably going to increase from a year over year standpoint, right? um it's also one of those frustrating things because you really have no choice around it, because you can't just move your house, right? If you like your house, You can't just like pick it up and put it on a new property and say I'm not paying property taxes anymore, right? Um, so yeah, it is a a bit of a nuisance, let's say that, when it comes to paying for property taxes. And kind of, I guess, even connected with the idea of picking up your house and moving it. The reason why you pay property taxes in the first place is not just simply because the municipality um, levies these taxes, um, but it's also because of the fact that though you own the property and in theory you own the land, you don't actually own the land that the property sits on. The 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 actual physical land at the end of the day is technically owned by your local municipality, and this is going to depend on how the land was purchased in the first place, right? There are places that you can buy land where you legitimately own that land, right? It's not there aren't property taxes associated with it because you aren't quote unquote on the grid, right? Like you're not getting the resources from the municipality. You're living off of your own land. You're not having their plumbing. You're not having their electricity or whatever, right? Um, that's where the kind of one side of things where the asterisk where uh, you don't see properties taxes being like connected to it, right? It's a very weird concept. That you can own a property like houses in particular, where you don't actually own the land, but that's kind of what you're paying for. I mean, yes, your house itself is what you're paying for, but you're also paying for the land that it sits on. Um, it's the reason why um, a lot of people would know that your on your driveway. I don't know if it's like whatever. I think it's like a certain distance from the curb, but even if you didn't have a sidewalk, technically speaking, that part of your property isn't kind of like it's like a bit of a gray area, but it's not like fully owned by you. And that's why a sidewalk can be put in like going through your driveway because the municipality controls all that. They own that land, and they can decide what they want to do with it and when they want to do it. It's the same reason why for a lot of neighborhoods you can't just take down a tree if you wanted to, right? You have to get permits and for all those types of things. Even for trees that are kind of dead, you have to get a permit for it. Um, because again, it's property that even though you paid for it, so to speak, it's not legitimately owned by you. So it's a real weird one in comparison to any other taxes that we've been talking about here. But yeah, you're essentially leasing your land from the government. Um, and so those things can always change. That's why like zoning laws, um, deciding where houses will be built versus other things, right? That's all decided by the government, and it's because it's their land. It's not just simply that a builder one day decided to like buy some land and build houses on it. They all it's a complete approval process to justify it at the end of the day. Um, Now, I do want to note, right, because I'm obviously bashing property taxes quite a bit, but um, property taxes are, I think I mentioned this at the beginning of the episode, but it's been a while now. um, they are one of the larger driving forces when it comes to tax revenue for municipalities. So there is some value in having property taxes because I mean, I'm not saying that the province or the state level or territorial level or whatever, depending on where you live, right, won't give money to the municipalities. But for a large driving force of it, the expectation is that the municipality is going to have to figure out how they're going to front the bill on their end of things. And property taxes, along with paying for parking, is one of the larger ways that municipalities make their money, right? Um, that in itself is obviously the justification for property taxes. But it's also one of those things that doesn't negate the fact that you, at the end of the day, when you purchased your house, you paid for the land value. You paid for the physical house. If you update your house and make it better, you paid for that, right? So it feels somewhat like a disincentivizing structure for property taxes, and it also feels kind of like you're a bit like cheated, right? Like if at the end of the day, if I'm just leasing my property, like the land from the government, then I feel like that should almost be a little bit clearer. It shouldn't be like, hey, I bought this and this is my house now. This is my land, my whatever. Um, sure, the physical things on the land I might own, but like I said, I can't unless it's like a trailer. You're not moving your house. It's stuck there. So you are kind of left with no choice when it comes to property taxes. And I think that's one of the tougher pills to swallow when it comes to a tax like property taxes. But yeah, so it 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 does have its pros, right? Like it does bring some value overall to society in the form of taxes for the municipality, but it really does not feel like a fun one to ever pay if you own a property, right? And I will tell people, like, if you don't own a property, let's say you rent right now, I'm going to tell you right now, unless the market doesn't work out in favor of this, more often than not, your monthly rent is covering those property taxes as well. So your rent is also higher because of those property taxes. And of course, living in a house or apartment or condo or whatever, um, that arguably is like an essential good, right? So whether it's that you're renting or it's that you physically own it, um, you're left with no choice but to just shell out those thousands of dollars towards um, owning that property, right? I can understand it maybe a little bit more when it comes to a boat. I don't even really understand it for that, but maybe I could justify that a little bit more. But I would just say, like, have public marinas and charge extra fees at the marina if that was going to be the case, right? Rather than a property tax. Um, but nevertheless, right? Um, hopefully that makes some sense. I don't necessarily know that I have a good alternative to it. I'm not a big fan of property taxes as a whole, but I do think that there's some value in the municipalities being able to garner revenue towards them. It's just that I feel like every way that a municipality has to get tax revenue, uh, most people don't like. which which seems crazy that your local government, the one that you should in theory get the most impact from, uh, doesn't have a great way of gaining support from you financially, right? It's a very backward system in that sense, but again, hopefully that all makes sense. Hopefully it justifies the case for why you should have property taxes, but also why, as a whole, there's a lot of fine line implications when it comes to property taxes. Because again, it's not like they are exploited, right? If you have a mansion, you're going to pay higher property taxes than someone who lives in a one bedroom home in a rough neighborhood. I don't know, right? But it is a weird one in some ways, because like if you couldn't afford, let's say you have money to make your house better, like you're living in that one bedroom house, um, you have the money to make your house better, but you don't have the money to kind of in perpetuity pay extra in taxes. Well, that kind of at that rate disincentivizes you from making your house better, which I think the goal should be that everyone should be making every property that they own or live in better, right? Like if we want things to last, if we want to have a better lifestyle, if we want to whatever, all those things, like why wouldn't we want everything to look as nice as they could, right? And I think indirectly, whether people fully realize it or not, property taxes kind of ensures that we have to do a double take when it comes to making those decisions. But yeah, hopefully that makes sense. I know I repeated a lot there, but property taxes, it'll get you. Next up on our list, we have tariffs. So trade taxes. Kind of as a whole, I don't know if I mean, I guess this is still implications of it, but it's like kind of why do they matter? What are we what are we really doing here with them? So, uh, like I mentioned at the beginning of the episode, tariffs are of course like a foreign tax, right? It's a foreign tax paid domestically, though, right? Which is kind of weird. Um, Anything that has a tariff associated, if you import that good domestically, then you are going to pay a tariff on that good, right? So we already talked about in the beginning of the episode that tariffs are looked at for protecting certain industries, right? And we also, the other side of it, looked at it as more of a political tool. So, um, you hear probably sometimes in the news about trade wars, right? That's often where you see tariffs being utilized. Um, so I don't know. Maybe you're angry with another country, so you impose tariffs on some of the goods that they typically export to you, right? So, like in the past, the United States has put tariffs on Canadian steel, for instance, right? And the hope is that you will one, like either incentivize you to use the domestic stuff, right? Like so, in the case of the U.S., maybe that U.S. Businesses will decide to just import or not import, but utilize the domestic supply of steel in that scenario. Or more importantly, that it'll just disincentivize you as a whole from going to purchasing like the steel from Canada. Maybe you're going to, I don't know, get steel from Germany. I don't know where, right? But that as a whole is what the whole purpose, I guess, um, with our utilizing tariffs, right? It's that it's used to disincentivize us from getting goods from one place versus another, or not utilizing our domestic supply of things, right? Encouraging the use of it. When it comes to the implications of tariffs, right? I said it was a foreign tax paid domestically. So in our scenario with like steel products from Canada, when it came to the United States, the US still was in a position that it's not really purchasing steel from anywhere else. Canada creates really high quality steel. It's geographically very close. There's lots of ways to get it here or get it to the United States. So on and so forth, right? Like, so at the end of the day, a lot of businesses still purchased those tariff or those steel products, right? And because of that, they had to pay um, the fee to the American government, right? Like, so the U.S. imposed those tariffs; they had to pay it towards their own government, right? We kind of talked about this uh, earlier, but what ends up happening is that if the cost of goods that you're importing costs more, then we end up just having a trickle down effect that instead of disincentivizing necessarily from a builder from purchasing steel from Canada, um, the builder instead will just charge more because the cost of those goods cost more um, to whatever, I don't know, whoever is building the build, like wants the building built. If it was for a hospital being built or a new office for a company or whatever, right? You get the idea that the cost associated with these tariffs often just gets pushed on the domestic population. So the company that had to import that good in the first place is paying more, and then all of the customers of that company are now paying more for that same good that they once had. So it has a bit of a double-edged sword, right? If you still want the product, right? I don't know, you still want Wisconsin cheese, and there's a tariff on American cheese being imported into Canada. Well, you're still probably going to go and buy that cheese, right? Like it's never to such an extreme that tariff will make sure that you 100% cannot purchase it, right? Because they know the implications of doing that would be detrimental for the um the domestic economy, right? Like, so the US would never put a tariff on steel so high that it's impossible to import steel, because then if you can't import that steel from like Canada, then the supply of that material is just so minimal that you're going to have its own implications on it, right? So sure, maybe no one's paying a tariff on it, but also now infrastructure is falling apart or whatever. So you're not going to have a situation where it completely cuts it off. So, and because of that, it means that your domestic population is really just going to front that bill. So sure, you're sticking it, so to speak, to the other country, and maybe you're also in a situation that if you normally whatever, if you normally export X amount of that good, like steel in our scenario here, um, maybe you're having a situation that you only can export 75% of that steel. So you're still hurting um, the country that you're trying to target, or the industries that you're trying to target outside of your country. Um, but it's the double-edged sword aspect, because you're also going to inevitably affect your own country by putting that tariff in place, right? Because cost of goods domestically will rise. It happens pretty much every single time that a tariff is imposed, is that because people still are going to import that good, or the cost of that good, or rather the increase in cost of that good gets pushed onto the consumer, right? And that really, at the end of the day, it doesn't matter what your objective is, whether it's the political tool, right? Like where it's we're at a trade war with China or the United States or whoever, um, or if it's like, oh, we have this local industry that we want to protect at all costs, and we don't want the market to be flooded with other countries' products, so we want to put a tariff on that. It very rarely has the full objective that I think countries want it to have, or at bare minimum, it's that they may achieve one objective, but they've just created another problem on another level, right? In the case that I just talked about, was this idea that uh, domestic goods now cost more, right? But yeah, hopefully that all makes sense. Um, it's one of those tools that is used a lot in international relations, because it's not as aggressive as, I don't know, sanctions or um, full out war for that matter. Um, but I think it lacks the diplomatic tact that I think it would like to have, on top of the fact that you're really just hurting your own economy at the same time, right? As much as it hurts the other country's economy, you're going to also feel the hurt at the same time. And in which case, like, what's the point? Right? That's my thoughts, at least. What's the point? Okay. Well, I promise you, we're getting there. We're at the last tax. And just kind of looking at it a little bit more in depth. It's estate taxes. We already talked about it just in general in terms of what they are, but like many taxes, estate taxes can be seen as both fair and unfair, depending on how they are utilized, and depending on who you ask, right? When you inherit wealth from a deceased family member or friend, you are gaining wealth that you yourself did not earn, right? This leads to some saying that you shouldn't be able to simply walk away with all that wealth, especially in the case of like an ultra rich person passing away, and handing down multi generational wealth, which we uh, definitely see, especially in the United States, but even in Canada, there are people that have accumulated that much wealth that, yeah, you're just being handed essentially out of nowhere, um, enough wealth to supply you for your life and your children's life and maybe even their children's life, right? Um, because at the end of the day, right, it feels like those people didn't earn it. You were just born into that family, or maybe even you weren't. Maybe you're just a family friend that got this, were the beneficiary of that wealth, right? The other side of that argument, though, is that it's irrelevant, all things considered, whether or not you physically earned that wealth. Um, Especially when it comes to all the other types of taxes and all that kind of stuff, that in theory, if I, let's say I have a good paying job, I make lots and lots of money, I invest my money, I accumulate a large sum of wealth by the time I pass away, and I'm passing that wealth on to uh my daughter, for instance, right? um I've already paid, in theory, and assuming that I did everything legitimately, I've already paid my taxes on that wealth, right? Um, I I earned it from doing my whatever work, investing and stuff like that. If I had to pay taxes on any of those things, I've paid the taxes, right? If I got it from a job, obviously I paid income taxes. If I have capital gains, I paid capital gains taxes on it, right? So on and so forth. So the fact that my children should then have to pay taxes on top of that just to be able to receive that wealth that I've worked so hard to pass on to them. Um, that doesn't feel like a legitimate thing either, right? Like, so it is a hard one because it is somewhat contradictory, especially when you look at your more extreme examples, right? So if you're looking at someone who is super, super wealthy, like an ultra rich person, who's passing on immense amount of wealth to someone who doesn't add any real value to society, um, that feels a little frustrating. And then at the flip side, their parent or whoever it was, their grandparent, at the end of the day, they somehow earn that money, I'm assuming legitimately. And so therefore, uh, it's hard to make the claim that that money shouldn't be able to be passed on if they wanted it to be passed on to their children or grandchildren or whoever. Um, so yeah, it's as a whole, I guess that's the real implication of it. Um, you don't want to have a system that taxes you twice for the same wealth, because if it just feels like it defeats the point, so to speak, right? Like it feels like an overextending of what's right. I don't know. Something along the lines of that, right? Um, and so I think by that it's one of the more trickier taxes to kind of really narrow down. I really think that the Canadian tax system uh, is definitely one of the better systems because it doesn't it doesn't charge you an estate tax, uh, as long as it essentially ensures that all the taxes that could have been paid by the individual who is now deceased and passing on that wealth has paid their fair share in taxes, right? So if I, like we said, if I have whatever, a bunch of properties and I pass away, um, had I been alive and sold those properties, would I have had to pay capital gains tax on it? Yes. Okay. Well, then pay the taxes, basically, right? On that stuff. Um, rather than putting it on whoever is inheriting my taxes. Sorry, inheriting my wealth. Um, but at the same time, I can understand why some people feel that there should be an inheritance tax when it comes to really wealthy people. Um, I just think that that is a slippery slope, um, to tax people for inherited wealth, even when it's someone like, I don't know, Elon Musk, who's worth whatever 200 some odd $billion, right? Again, I don't think he necessarily like has that in cash type of situation. So, but his net worth is 200 and something $billion. So if he's handing down billions of dollars to his children, um, who I don't know, maybe not maybe didn't contribute anything to the acquisition of that wealth, right? Um, it's hard to say that that feels justified that they get that, but I also think at the end of the day, it really is, because that's their family's wealth. And as long as I think what I would say is this: the issue is not that rich people are passing along tons of multi-generational wealth. The issue comes into play is how do we feel that, did the people who earned that money in the first place, was the earning of that wealth justified, right? And I think that is sometimes what doesn't sit well with us, right? The fact that Elon Musk is worth, like I said, 200 some odd $billion, that's an unfathomable amount of money, right? Like, all things considered, that really is uh, out of this world kind of money. Um, and so trying to justify that one person can be worth that much, and he's one of many that fall into the category. Um, I think that is where um, the issue comes into play, rather than should the kids or grandchildren of said person be able to reap the reward and benefit of their grandparent, right? um or parent or whatever. um that's really what our kind of, the thing I think we get stuck on, right? Like, what most of us would have issue with. But as a whole, I think it is, if you have a legitimate system that allows people to make money in legitimate ways, and it's not an exploitation of the system, I don't really believe that they should have to pay taxes on their own personal side of things when you inherit money, right? I think, if, as long as the taxes were paid by the deceased, then you should be able to do with it what you want, right? But yeah, hopefully that makes sense. I know we've gone through a lot. That's seven different, like, taxes that we just covered. Um, but yeah, I hope that does give a bit of a sense. I feel like this episode is gone way too long as a whole. Um, there was, maybe I'll try to do it as quickly as possible. One other thing that I wanted to kind of really touch upon, and I think there's a common theme with all of these taxes, and that when we're trying to get a sense of what do we have currently and how can we be better, right? Our This is what our system is, why it is the way it is, how can we make it better, how can we improve upon it, right? When we're looking at our tax systems like that, I think almost universally, for all the categories that we talked about today, it really does come back down to this idea of taxes affect um, people on different levels. It's not about necessarily the percentage of things or what have you. It really does come back down to this idea that those with very little feel a lot larger of a burden when it comes to taxes in comparison to those who have a lot and may even pay a lot in taxes, right? I mean, again, we've already established that there are a lot of times that you can be a big wealthy corporation that makes tons and tons of money, or even a wealthy individual that makes tons and tons of money and pay very, very, very little in taxes. So that's always still going to be a reality. But even in an ideal world where wealthy people pay lots of money in taxes, you're still probably more often than not in a better situation by a long shot than those who have very little, right? It's all very surface level, I think, the way that our tax system works right now. It's like I said, it's a very equality based system, which definitely has its merits in some cases, but in other cases, more of an equitable system would be beneficial. And that if we wanted to really understand the change that is needed, we do need to look at people's individual situations or businesses' individual situations or whatever that may be, right? Because we know that, like I stressed it throughout this episode, that if you only have a small amount of dollars in the first place, you need to count your pennies, as opposed to someone who has a lot of money. They're really counting their $100 bills or something like that relative to you counting your pennies. It's a totally different scale. And again, I know that there's always that argument of go get a better job, go do more to better yourself. And I'm not disagreeing with that in the general statement of you should do better, do as good as you can in life. You should try to provide for yourself as good as you can in life. You should, whatever, spend time trying to build your wealth. I don't deny that one bit. That is something that I full-heartedly believe in. But I also recognize that that's not always a reality for everyone. That's not always uh, uh, an automatic um, measure for success, I guess is what I would say, right? So we can have situations where you can try your best and do all these things, but that doesn't mean that you're always going to get ahead of life, right? And I really do think that the charity example should spell it out as well as possible for a lot of people, right? Um, like if you're giving even the same percentage of your wealth, right? The impact is very different for someone who has very little versus someone who has a lot, right? If I give 10% of my wealth versus someone who only makes $40,000 a year and they give 10%, well, they're going to feel it a lot more. But at the end of the day, we kind of sacrifice the same amount from a numerical standpoint, but from a real world impact on our individual lives, there's no way, there's no contest in the sense of someone who has next to nothing giving 10% of their next to nothing left them with even less. Right? Like that hopefully is a message that can be applied to just about any of the taxes that we've looked at, minus obviously things like tariffs, where I hope that one is something that we realize that from a political standpoint, I guess we need to be find better tools to get our messages across, because we're just hurting our own population domestically more than we're um getting ahead when it comes to diplomatic relations with another country, right? um Again, I mean, maybe you don't put a tariff on a good if you're trying to protect a resource. Maybe you limit the amount. Um, you kind of have to put out grants where people can purchase, um, whatever, that you're allowed to buy cheese. There's only a certain amount of cheese that's allowed on the market, rather than putting a tariff on that cheese and making that cheese more expensive than it needs to be. But yeah, I hope that this all makes sense. I had here that I was originally going to tell you the example of when George Lucas sold Lucasfilms to Disney, and how he uh, donated, I think it was like $4 billion that he pledged to donate, which is like, again, an astronomical number. Like $4 billion is wild. But it also, if I just told you George Lucas is donating $4 billion, and I love George Lucas, first off, like, but so this is not a knock on George Lucas, but if you're donate, if I told you he's donating $4 billion when he sold it to Disney, you kind of forget the moment that, oh, George Lucas, before he ever sold Disney, was a multi-billionaire. So when you're already a multi-billionaire and you come into another $4 billion, donating $4 billion is not changing your life. Like, Skywalker Ranch is still going to be there. All the amazing things that he's achieved are still going to be there. His lifestyle is still going to stay the same, because you can only spend so much money. So sure, is he justified in wanting to keep that $4 billion? Of course, that's his that was his prerogative, in the sense of, he worked hard to build that Lucas Arts and Lucasfilms, and uh, his lighting company and all that other stuff that he sold to Disney. He built that from the ground up with his team. But is he also amazing for donating it? Totally. But I also have to say that, like, it's not as crazy as someone who made $30,000 and donated whatever, uh I don't know, 50% of their wealth, right? Like, if that, I forget how many how many times over George Lucas was already a billionaire. He was a multi-billionaire. I forget what the exact total was, but um if, let's say he already had $4 billion, he came into another 4 billion, he gave away that 4 billion, so he gave away 50% of his wealth. Well, if you had $30,000 and you gave away 50% of your wealth, you are you're in a whole different world of hurt and personal sacrifice, in comparison to someone who just gave away $4 billion. But nevertheless, I hope that all makes sense. I know that was a ton of information. I know that this has been a relatively dry episode as well. I appreciate if you've kept with it for this long. But like I kind of mentioned in the intro of this episode, um, taxes are a huge part of our lives, and I hope you can see, they have huge implications on our lives. They're also very complex systems, and I feel like a lot of things, they're designed to be very complex so that you don't necessarily get to understand them to their fullest, and you kind of just accept them, right? Because they're too complex. Um, but yeah, I hope you've learned something. I hope that you uh, didn't get too bored of an episode like this. Um, but more importantly, I hope that you are starting to think about how we can improve some of the systems that we have, right? And again, there's so many working parts with all of these things, especially, we just talked with taxes. Like, we're talking about taxes in almost every aspect and capacity of our lives. So um there's lots of other moving parts that are adjacent to taxes, that are affected by taxes, right? And vice versa. So we there's a lot of pieces to kind of connect together, and taxes are just one of those pieces. But I do really believe that it is an integral piece. It's a corner piece on that puzzle, to kind of make sure that we are looking at these things in a lens to say, is it achieving what we want it to do, right? The purpose of this tool, in this case taxes. And on top of that, if it's not achieving that, how could we tweak the system, create a new system, whatever, right? Anything in between, um, with the goal of getting closer to where what our actual purpose for these tools are. Nevertheless, my head is spinning. Your head is probably spinning. Lots of information. I'm sure you probably have taken multiple sittings just to even listen to this episode. I know I would. But I really appreciate you sticking with me till the end here. And we'll catch you on the next episode where Jordan and I will be discussing um, this idea of like whether or not we should even have taxes, right? And all the implications and everything that go along with that. So that one hopefully will be a little bit more fun of an episode, a little less dry. But once again, I hope you learned something. Thank you as always. My name is Braden. This was the Realist Idealists, and this is Powerview.